All right, let's talk about one of the most polarizing stocks on the entire market, Tesla. For years, you've had this huge debate raging among investors about what this company actually is and what it's really worth. Well, today, we're going to dig in and try to get to the bottom of it. And this is really the core question, isn't it? Is Tesla just a car company? Pumping out millions of vehicles, but also facing this absolute tidal wave of competition? Or is it something else entirely? A visionary AI and robotics company that's priced for a future that we can barely even imagine. How you answer that question? Well, that decides if you think the stock is a massive bubble or if it's just getting warmed up. So in this explainer, we are going to break down the evidence for both sides of that argument. So here's how we're going to do it. First, we'll hit the bear case and look at some of the cracks in the foundation. Then we'll flip it and explore the bull case, which is all about a future beyond cars. After that, we'll decode the financials, lay out our final valuation and verdict, and then, for good measure, we'll even look at an alternative way you could play this space. Okay, so to really understand the risks here, you have to start with the numbers, and more specifically, how Tesla accounts for its biggest software ambition, full self-driving. And to do that, we first need to get our heads around a key accounting term. And that term is deferred revenue. Honestly, the easiest way to think about it is like a gift card, right? When you buy a $100 gift card, the store gets your cash right away, but they can't actually count that as revenue until you come back and spend it. Well, Tesla does something pretty similar with FSD. Customers pay them thousands of dollars up front, but since the software gets better and is delivered over time through updates, Tesla only recognizes a little bit of that cash as revenue each quarter. Now, this whole accounting method creates a couple of big risks for you as an investor. First, it's complex. It can make it really hard to tell what's really going on with their software business. Are sales actually growing, or is it just the accounting making it seem that way? And second, this allows Tesla to smooth its earnings. They can release chunks of this deferred revenue over time to make their quarters look more consistent. And while that might sound good, it could also mean that the company's profitability right now is actually being understated, making it super tough to figure out the company's real financial health. And that brings us to the single biggest piece of recent bad news and a huge point for the bears. Just this April, Tesla took a knife to the price of its full self-driving package. They slashed it by a third, dropping it from $12,000 all the way down to $8,000. Now think about that. For a company whose entire bull case is built on future software profits, cutting the price of your main software product by 33%, well, that is a massive red flag about demand. Okay, but to be fair to Tesla, the bulls will tell you you're looking at this all wrong. They argue that you have to look past the cars, past the accounting debates, and see what's really happening. They believe the company is in the middle of this massive pivot, from a company that just makes hardware to a dominant force in AI and robotics. Let's see what that case looks like. The bull thesis really stands on three giant pillars that honestly have very little to do with selling cars today. First, you've got the Dojo supercomputer. This is their custom-built machine designed to train the AI not just for their cars, but maybe for their robots too. Second, and this is the big one, the Optimus humanoid robot, which is aimed at completely revolutionizing manufacturing, logistics, you name it. And third, network services. This is the vision of a future where millions of Teslas are out there generating recurring revenue from self-driving, charging, and maybe even in-car content. And to really wrap your head around the ambition here, just look at Optimus. Tesla has said they plan to be able to make 10 million of these robots a year by 2027. Now, to put that into perspective, the entire planet, the entire world, produces about 500,000 industrial robots a year. Tesla is aiming for 20 times that. It is an absolutely staggering manufacturing goal. And this slide really shows you why they're thinking so big. The goal here isn't just to build a robot for a car factory. No, Optimus is designed to be a general-purpose humanoid robot. That means the potential uses are, well, they're almost limitless. We're talking manufacturing, logistics, airport security, maybe even healthcare. The bulls don't see a niche product. They see a platform that could completely reshape huge parts of the global economy. All right, we've heard the bear case. We've heard the bull case. Now, it's time to ground this whole debate in the company's actual financial health. When you're looking at a company this complex, there are really four key numbers that every single investor needs to be watching. Okay, first up, revenue growth. As you can see, it's been decelerating lately, which is a big check mark for the bears. This number just tells you if the core business is still growing or if it's starting to hit a wall. Second, gross profit margin. This is how much profit they make on each car. Historically, it's been strong, but it's been under pressure. It's a key sign of their pricing power. Third, debt to equity. The good news here is Tesla has its debt under control. This is a huge risk metric. And finally, free cash flow. The company is generating cash, which is a fantastic sign. This might be the single most important indicator of a healthy, sustainable business. So with all of this evidence on the table, the accounting risks, the mind-bending AI ambitions, and the core financials, how in the world do you put a price on this company? Well, this is where we pull it all together and land on our final verdict. The first thing you'll notice is that Wall Street analysts are just all over the place. I mean, price targets for the next year go from a low of about $110 a share all the way up. Our analysis, which leans heavily on a key report from Morgan Stanley, you can see their target is the highest one there, really focuses on that high end of the spectrum, where that whole AI and robotics vision starts to come into focus. So taking every single factor into account, our analysis leads to a definitive investment recommendation. We believe the massive long-term potential of the AI, robotics, and network services businesses fundamentally outweighs the short-term risks in the car business. For that reason, our recommendation is a buy. We recommend a buy with a 12-month price target of $400 per share. Now, this target assumes that the market will start to value Tesla less like a car company and more like the AI and robotics platform that it is so clearly trying to become. So let's just boil this entire thing down. The single strongest argument for this buy rating is the belief that Tesla is pulling off this incredible pivot into a dominant AI and robotics company, unlocking markets that are just way, way bigger than the car industry. The biggest risk against it? It's one word: execution. If Tesla fails to actually scale Optimus, or if they can't monetize their AI on schedule, the whole bull case just falls apart and it gets valued like a normal car company. Now look, a $400 price target, that implies a lot of upside, but it also comes with that huge execution risk we just talked about. So for investors who are really interested in this space, but maybe a little nervous about that kind of volatility, there are other ways to play these trends. For example, if you want exposure to the EV boom, but without that speculative AI premium baked into the stock price, a company like NIO offers a more pure play investment. On the other hand, if it's the robotics revolution that really gets you excited, a company like Boston Dynamics offers a much more focused way to invest in advanced robotics, without all the baggage and complexity of the global auto industry. At the end of the day, an investment in Tesla right now is a high-stakes bet on their ability to execute. The vision is massive, the ambition is off the charts, but the one question every investor has to ask themselves is this: can they actually pull it off? Will this vision of an AI-powered robotic future become a reality on schedule? That is all for this deep dive. Now, I want to hear from you. What company should we put under the microscope next? Drop your suggestions in the comments below. And hey, if you want more explainers like this one, make sure you subscribe. Thanks for watching.